Welcome to another presentation of Capital Economics. Today we're going to be discussing and continuing our conversation with some recession indicators, looking from a high level, from some macro indicators. Today we are asking the question regarding the Federal Reserve, are they pricking bubbles? So let's get into this. Now obviously, since we're talking about recessions, I believe it's prudent to understand what it is we're actually talking about, making sure we're on the same level when it comes to the definitions of a recession, because if you're paying attention to the mainstream media, if you're paying attention to the financial news outlets, if you're listening to Wall Street, or if you're listening to Washington, D.C. and the politicians there, they are likely going to define a recession as 2 consecutive quarters with negative GDP growth. Now, this is fine and dandy for those respective entities. However, Wall Street, the mainstream media, and politicians are not responsible for making the official determination as to when the United States has entered a recession. That responsibility lies and rests with the National Bureau of Economic Research, the NBER. So just to make sure we're all on the same page with what an actual recession is, a recession is a period of falling economic activity spread across the country lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. The trough marks the end of the declining phase and the start of the rising phase of the business cycle. Economic activity is typically below normal in the early stages of an economic expansion, and it sometimes remains so well into the expansion. So, the committee within the National Bureau of Economic Research makes the determination. It is not 2 consecutive quarters of negative GDP growth. Historically speaking, that tends to coincide with a recession, but that is not the definition. It doesn't just take into consideration real GDP. It takes into consideration income, employment figures, industrial production, and wholesale retail sales. So those are the other things that we will be paying attention to, and those will also be a part of this series of presentations. So what we're going to focus on here is what the Federal Reserve has a lot of influence and control over, and that is obviously the effective federal funds rate, more commonly referred to as the Fed funds rate. Now, when we talk about the FOMC, the Federal Open Market Committee, this is the committee within the Federal Reserve that is responsible for setting and determining monetary policy. So when you're listening to the mainstream media, when you're talking about the Federal Reserve determining interest rates, this is what they're talking about. This is the decision that they are making. They are adjusting the federal funds rate. This is an interest rate in which banks lend money to each other to make sure that they are within compliance of their reserve ratios and reserve requirements, I should say. So this is an important rate. Markets go ballistic on this rate. They follow it very closely. You will see the stock market, you will see the bond market, you will see currency markets respond to these decisions from the Federal Reserve. They will move perhaps quite sporadically. They could be violent swings, or they could be, well, it was anticipated, and it could be a big nothing burger. But nevertheless, this is a number, this is a decision that is made by the Federal Reserve that keeps the markets on pins and needles, especially in the current environment in which we find ourselves. And if you're interested on a more in-depth analysis of this and discussion on what the federal funds rate is and what the Federal Reserve does, I please ask that you join our podcast and our website at thecapitalnews.com to have and become a part of those conversations. So here, looking at the Fed funds rate, and obviously we're going back here, back to 1954, we're not going to concern ourselves with that data. We're really going to focus on the last few recessions, because I believe we are currently in a new paradigm regarding the Federal Reserve and their involvement in the financial markets, particularly concerning themselves with the stock market. Now, at least publicly, over the last 30 years or so, we pay attention to this because it is very important. Now, because it moves markets, so we have to pay attention to this. So if we're looking at this graph, and just so you understand that we're all on the same page, these vertical lines that we have here, these vertical gray lines, These are recessions that are determined by the National Bureau of Economic Research. Clearly, the thickness of these lines is indicative of the duration. So obviously, the thicker the line, the more severe the recession, which is evidenced here in the most recent recession, which was during the Great Financial Crisis and the Great Recession. So if we go back to the 1990 recession, and I want to pay attention to, like I said, the last few recessions, because I believe we're in a new paradigm regarding central banks. This was when we were under the leadership or lack thereof of former chairman of the Federal Reserve, Alan Greenspan. Okay? And Alan Greenspan wanted to make sure that the markets were A-OK, that they weren't going to suffer any sort of major sell-off. Of course, that did not end well, but that did not stop Mr. Greenspan and company at the Federal Reserve from trying. And we're going to get to that as we make our way through here. But what I want to focus on here is a couple of these trend lines that we have. Okay, one that started back here in the 1980s and continues to the present day, and then one that started through the 2000 recession and continues through current day as well. Now, what I want to pay attention to here is when you have the 2001 recession. Now you have the Great Recession. Where are we today? It appears to me, just graphically speaking, that it is taking an ever smaller interest rate to prick or to cause the bursting of an ever-increasing bubble. Okay? And to me, this makes intuitive sense because the bubbles are getting bigger. That means the bubble is more fragile than it was in its prior state because the Federal Reserve wants to come back and save the day. It wants to reflate and inflate the bubble. Okay? The Federal Reserve, for all intents and purposes, plays the role as both the arsonist and the firefighter. Okay? So you can see here we had interest rates only back in 2000 north of 5%, almost 6%. During the Great Recession prior to it, they were north of 5%. Now we are currently we are range bound. We are range bound between 2% and 2.25%. And we have people shouting from the rooftops, including the President of the United States, that interest rates are too high and they have to go lower. I mean, how much lower do you want them to go? Do you want them to go back to zero? I mean, is that what's good? Is that the policy we want? Because this zero interest rate policy in conjunction with quantitative easing is what caused the bubble. So I can assure you, ladies and gentlemen, regardless of whether or not the Federal Reserve increased interest rates or not, this bubble was going to burst. This economy, and all other economies for that matter, would be entering a recession at some point. Why? Because recessions have not been outlawed. Why? Because recessions are a normal and healthy, very healthy part of the business cycle. It gets rid of malinvestment, at least it's supposed to. That is, of course, unless the Federal Reserve or other central banks or the federal government steps in with massive amounts of stimulus to keep everything propped up. This is not good policy in my opinion, but nevertheless, that is what they attempt to do. So, where are we currently? We're at 2 to 2.5%. The other thing I want you to be mindful of are these plateau effects here, which is basically a wait-and-see period. From the Federal Reserve. Are they going to be data dependent? Or are we just going to see what's going on? They're sort of mindful that they are that the business expansion and the business cycle is getting long in the tooth. So let's just become data dependent. Let's just wait and see what happens. Well, we can see here, graphically speaking, that following this wait and see mode, once the Federal Reserve begins to cut interest rates, it's just a matter of time before the recession actually takes place. You can see here in the 2001 recession, you can see here in the Great Financial Crisis, and now you can see where we are currently today. And this is the purpose of this presentation and others like it in this series where we're looking at a bunch of financial and economic data to make the determination when we are likely to find ourselves in recession. Now, for those of you who are also followers of thecapitalnews.com and our podcast, The Capital News, you are aware that I have been stating that while officially we are told that the Fed funds rate is range-bound between 2 and 2.25%, I actually believe that it is slightly higher than this, possibly closer to 3%, maybe even a little bit north of 3%. I also happen to believe that the Federal Reserve believes that the de facto Fed funds rate is also higher than the official rate. I say this because, according to the Federal Reserve's own research, some of their own internal economic research papers, you have had economists saying, well, let's look at this now. Not only are interest rate increases, okay, not only is that a part of the tightening cycle, but so is quantitative tightening. And quantitative tightening, they argue, also has the effect of increasing interest rates. So for nearly a decade, during the financial crisis and several years after the financial crisis, we were zero bound here in the United States. We had zero interest rate policy. We also had quantitative easing. This was the Federal Reserve's attempt to throw more money, more liquidity out into the system, to reflate the system, to inflate the system. Inflate primarily financial assets, stocks, bonds, commodities, real estate, and they succeeded to a large extent. However, this is what is causing the current bubble in which we find ourselves. Now, the Federal Reserve has found itself over the past year or so increasing interest rates, but also reversing quantitative easing and going with quantitative tightening. So for nearly a decade, the Federal Reserve was throwing vast amounts of liquidity into the system. Now, through interest rate increases and quantitative tightening, they are pulling that liquidity out of the system. Okay, so again, the Federal Reserve playing both the arsonist and the firefighter. Okay, so with their research, they are saying quantitative tightening has the effect of increasing interest rates as well. So if that's true, and I believe that it is, we're actually probably extremely close to our trend line. I don't necessarily believe that we have to hit this trend line to say, okay, well, we hit the trend line, now we're going to be in recession. I don't think that's the case. I just happen to also believe that it is at this current time. So that's something that we're going to pay attention to. Now, the other thing, again, if you've been following our podcast at the Capital News, I stated that during the July meeting of the Federal Reserve that we had to pay attention not only to, obviously, their decision in regards to whether or not they were going to cut interest rates, and of course they did cut interest rates by 25 basis points, which is why we find ourselves in the current range of 2 to 2.25%. But I said you also have to be mindful of their decision regarding quantitative tightening, because if the Federal Reserve kept to their schedule, they would have continued with quantitative tightening until September or the end of September. But they didn't do that, folks. They said we are also going to stop quantitative tightening, which signals to me that they believe their own internal research, their own internal working paper that says, yeah, quantitative tightening is also responsible for increasing interest rates. It has the same effect. Okay, so that's something to be mindful of. So with that said, when is it likely that we're going to find ourselves in a recession? What is the timeline between when we have wait and see, this plateauing effect, versus a rate cut effect, as to when we find ourselves in recession? So with that, let's look at our next table. Now, for those of you who may have also looked at our previous video presentation with unemployment, this is very similar analysis. So what we're looking at here is the past few recessions, and we're looking at the peak federal funds rate during the cycle, and we're looking at the first rate cut after the peak federal funds rate. Okay? And this is just simply that wait and see mode, and when they start to cut, and when we find ourselves in recession. So the first recession that we are going to look at is the 1990-1991 recession. So if we look here, we have March of 1989, the peak federal funds rate was at 9.8%, quite a distance away from where we currently find ourselves. So we had a plateauing effect, or a wait and see period, of 7 months. Okay? On October of 1989, you had your real first rate cut, and it took us to 8.9%. Okay? This was 9 months, peak of expansion. Of course, now you hit the peak of expansion. The only way you go from there is down, which would be the start of the recession. So we have October, just so you understand how to read this. So we have October 1989, that's the first rate cut. 9 months following October takes us to the beginning of the recession in July of 1990. Okay? However, the Federal Reserve continued to cut interest rates. So we had another period here, okay? We had in January of 1990 all the way to October of 1990, we had a second waiting period here, okay? This again was the Greenspan Federal Reserve attempting to support the markets, all right? And you could see that graphically if we went back to that table, to our chart there, okay? So here, however, they cut rates in November of 1990 to 7.8%. This was a cut from the plateau. However, at this juncture, folks, we were already in recession. We were already in recession. The Federal Reserve was late to the party. This is what they were doing, okay? So this is an interesting period in time, and real quickly, we'll go back and just to show you. This period here during the 1990s, all right, this is where you had, and you might be, again, familiar here with the terminology, the Greenspan put, all right? That was basically Alan Greenspan coming to the rescue of the markets. No, if there was any type of sell-off, if there was any type of worry in the stock market, rest assured, Alan Greenspan and company at the Federal Reserve was going to come to the rescue and cut interest rates to support the market. All right, and that's exactly what they did. However, this didn't end so well if you understand what happened with the dot-com bubble. The NASDAQ, which contained most of these tech companies, suffered a near 80% decline. It took years to experience this meteoric rise from base to peak with a lot of these stocks in the NASDAQ. It only took about 2 years to see a loss of 80%. So that's not a good record. All of this was basically for naught. It was short-term gain for very significant pain that was virtually inevitable. So moving along here with our analysis now, the next recession took place and began in March of 2001 and lasted approximately 8 months and finished up there in November of the same year. So continuing with the analysis. July of 2000 was the peak rate, 6.6%. The Federal Reserve said, okay, we'll have another wait-and-see period. This lasted 6 months. Then they cut interest rates on January of 2001. They cut them to 5.9%. Here, 2 months, only 2 months after they cut interest rates, were we in recession. Okay, so that's a lot quicker than 9 months from the 1990 recession. Continuing now with the Great Recession, starting in December of 2007. So we have to go all the way back to August of 2006 to find the peak federal funds rate, which at that point was 5.3%. There was an extended wait-and-see period or plateauing effect of 14 months. 14 months. They then cut interest rates in October of 2007 down to 4.7%. Here, just like in 2001, it was only 2 months that we found ourselves in recession. So, looking at where we find ourselves today, what can we glean from this, from a historical perspective? So, we know that we had a peak federal funds rate of 2.4%. You heard me right, 2.4% back in January of 2019, because you have to remember, the Federal Reserve continued to cut rates at its last meeting in December of 2018, and we also saw that major market sell-off through the last quarter of 2018 as well. But you can see here, folks, 2.4% is nowhere near where we were in the previous recessions. I mean, back in 1990, we were at 9.8%. Could you imagine having a federal funds rate of 9.8%? Not even close. We're not even close to that, and we have people complaining about where we are, and that's because of the fragility of the current environment in which we find ourselves. So, we hit our peak here in January of 2019 at 2.4%. We have been in a wait-and-see period for 7 months because the Federal Reserve just cut interest rates at its last meeting at the end of July. So, from a historical standpoint, where does that place us? Well, we know our current range is at 2 and 2.25% on the federal funds rate. When are we likely to find ourselves in recession? Simply looking at the past few recessions. Well, it could be anywhere from August, 1 month on, to about 9 months, because just historically speaking, that was the longest period of time in the data in which we're looking at. Now, it's also interesting, if you would also view our previous video on unemployment, that once the unemployment rate bottoms out, which we believe it has, 9 months from that date, you're likely to find yourself in recession. So basically, using 9 months, you could say that unemployment gives birth to a recession. Well, could that be the same case here for the federal funds rate? It'll be interesting to see, but this is where we're going to start to see some overlap. So when we're trying to pinpoint when we're likely to find ourselves in recession, this is the thing that we're going to be continuing to do. Now, we looked at unemployment. Here we're looking at the federal funds rate. In subsequent videos, we are going to be analyzing real incomes. We're going to be looking at production. We're going to be looking at wholesale and retail and wholesale figures, because that is what the National Bureau of Economic Research looks at. We're also going to be doing some analysis on the yield curve and a whole host of other financial and economic variables to find an overlap as to when we're likely to find ourselves in recession. But if we're just simply looking at this data here regarding the federal funds rate, we're saying, well, anywhere from 1 to 9 months, where we're going to hit the peak of this business cycle, which you have to understand, folks, this is the longest expansion in U.S. history. The longest in U.S. history. Okay, so 1 to 9 months, we could have hit it in August of 2019, or we could go out to April of 2020. That's where I'm going to leave this, because we're going to continue with other numbers, we're going to continue with other data, but these are important economic puzzle pieces that we have to analyze when we're trying to put this puzzle together and to paint a vivid picture as possible so that we can be prepared, financially speaking, and set our portfolios accordingly. So with that said, thank you so much for joining me. Please like, share, subscribe, get the word out, and leave your comments. We do love hearing from you. You can check us out at thecapitalnews.com. You can check us out on our YouTube channel at The Capital News, also on iTunes. And you can check us out on Twitter at the following handle, Capital, as you see there. Also, you can support us by buying our book, The Cynic's Guide to Investing in the Era of Too Big to Fail, It Pays to Be a Cynic. Our book is available at barnesandnoble.com and amazon.com. Also available on a Kindle version. So I will wrap it up there, folks. As I like to say, stay diversified, stay vigilant, and stay with the Capital News. Take care.